Talk to me about investing out of state and how you do your due diligence to ensure it's the right deal and that it pencils correctly.
We want to be in areas that have all the check marks, right? We have our fundamental criteria. We obviously want to have positive cash flow. We really boil it a lot down to like supply and demand, because we know if there's an undersupply of housing in an area and we're building houses in that area, then they're probably going to have large tenant demographic pool, large buyer pool, and have strong growth. But we do, I mean, we attend city planning meetings. We take it really down to the ground floor level. Where are jobs being created? Where's transportation? And looking at areas. One thing we've really done well, Aviva, that is focusing on secondary markets and tertiary markets. These are areas like outside of a 20, 30-minute commute, outside of a large metro area. Orlando is a perfect example, where Orlando, it's highly regulated, it's highly taxed. It's very hard to cash flow in Orlando. However, you can be just 20 minutes outside of Orlando, where the rents are still extremely high, home prices are a fraction of the cost, and there's an undersupply of housing because a lot of people are moving to these areas where they can still commute to the metro area if they need to for work or whatever, but the home prices are just more attainable and there's more upside. So that kind of makes sense. So like Polk County, or an area called Poinciana outside of Orlando, would be an area where we can buy a $250,000-$300,000 house that's going to rent out close to the 1% rule to really maximize cash flow. And this is on an
Wow.
A-class new construction home. Like, that's unheard of in a lot of the markets that we may be familiar with, which is more of the metro areas. But we really want it. We have boots on the ground teams in each one of these areas to handle management, then construction, maintenance, to do market analysis.